Why is local government debt still a structural issue in 2026? When people talk about China's economy, they usually focus on growth rates. But growth is the visible layer. Underneath, there is a quieter constraint: local government debt. This is not a sudden crisis story. It is a structural issue that shapes how much policy space local authorities actually have, and policy space determines how fast stimuli can move local government debt in. China is not a new phenomenon. It expanded significantly during past infrastructure-driven growth cycles, especially after the 2008 global financial crisis. To sustain investment momentum, local governments relied heavily on financing vehicles, often known as local government financing vehicles (LGFVs). These entities allowed borrowing beyond formal budget limits. Over time, three structural dynamics formed. First, land financing came deeply embedded in local fiscal models. Revenue from land sales supported repayment expectations. Second, infrastructure spending became a growth stabilizer. When external demand slowed, local projects filled the gap. Third, implicit guarantees created a blurred boundaries between public and quasi-public liabilities. As the property market adjusted in recent years, land sales revenue declined. This reduced cash flow at the local level. At the same time, refinancing pressure increased. The key issue today is not immediate default risk at the systemic level. The issue is fiscal flexibility. High debt servicing burdens limit the ability of local governments to launch new stimulus programs without central coordination. In other words, the constraint is about marginal capacity, not collapse. There are already adjustments, mechanisms in motion: debt swaps, extended maturities, greater central oversight, selective restructuring. But structural transition takes time. Local governments are now balancing three objectives: maintaining growth, managing debt risk, preserving social stability. Each objective pulls fiscal policies in different directions. This is why local debt remains a structural issue in 2026. It shapes how policy is implemented, not whether growth exists. The macro implication is clear. China's fiscal system is moving from expansion-driven leverage towards risk controlled adjustment. That transition defines the current phase.